Bloomberg Daybreak. I'm Kaylee Lines in the Hewlett-Packard Enterprise Green Room. Coming up later today on Bloomberg Markets, an exclusive interview with Mario Centeno, Eurogroup President and Portugal Minister of Finance.
Happy Jobs Friday, everybody. If you were long stocks and you were shorting bonds, you're feeling pretty good right now as yields are jumping higher on a better than expected number. 223,000 jobs added in May as the unemployment rate drops to 3.8% and average hourly earnings rising to 2.7%. For more on that jobs report, we welcome Ira Jersey, Bloomberg Intelligence Chief U.S. Rate Strategist, joining us in Princeton. So, short the Treasury market. If you're doing it, you're feeling kind of happy right now.
Yeah, we saw a little bit of a sell-off. We were actually selling off going into this. I think part of that was President Trump's tweet suggesting that maybe the numbers would be pretty good. I think in general, this just shows you that the trends in the economy continue at a reasonable pace. And we did have two weakish numbers in March and April. So the fact that we bounced back here a little bit in this jobs report, I think, is a positive sign for the economy. It means that the Fed is still likely to be on the same path that they were before the market weakness earlier this week.
Yeah, great point. And we can see that reflected already in the market. If you come inside the Bloomberg, the white line is the expected Fed hike rate in 2018, now moving back up to 3.2. And the yellow line, which is the Fed hike rates expected in 2019, moving a little bit higher as well to 1.5. Does 4 hikes this year get really put on the table now?
Well, so we're still in the 2 more camp, so that would be 3 total hikes in 2018. I think what's important is the total number of hikes between now and the end of 2019. That's really what the bond market's going to worry about. Whether or not, one of those hikes happens in December or March next year is not as important as what is the terminal rate. And we are getting more and more Fed speakers. So you had Lyle Brainerd, you had James Bullard. They've all come out and said, hey, we're pretty close to neutral. So the question is, how much further beyond neutral are they going to go? So, Lyle Brainerd thinks we can go above neutral. Some other members of the Fed are a little bit more skeptical that they'll be able to do that. So I think it's really that terminal rate that's going to matter a lot more to the market than the exact timing of hikes.
I completely agree. Of course, Bullard and Mr. Kashkari, front and center on that debate. All right, Ira Jersey of Bloomberg Intelligence, thank you very much. Well, the largest private employer in the U.S., Walmart, is holding its annual shareholder meeting in Fayetteville, Arkansas. And joining us now from that meeting is Bloomberg's Taylor Riggs. Taylor, with wages and jobs front and center here in New York, what are you hearing on the ground?
Huge. That's all the news here that we're talking about. As you know, they used the tax benefits earlier this year to increase wages, that minimum wage up to about $11 an hour. There was some talk on Wednesday about if the board needs to do more. That vote was turned down at the shareholders meeting, but they recognize that it is a tight labor market and increasing wages is one way that they can really retain employees. Interestingly enough, they're working on some of the other benefits that they're doing as well. They announced a new tuition policy program where for about $1 a day, they will fund employees to go back to school to help with that retention rate and to keep good workers in the store. When it comes to productivity, they've also introduced a new rollout of some new robots. They have the highest employee turnover in the back of the store with these fast unloader, what they're calling it. It'll help the employees go more to the front of the store where they're happier, more customer facing. So that's something that they're doing. And as you know, it's a tight labor market. The retail quit rate, we have a chart now at about 2.9%. That's higher than the national average. It's not where it was pre-recession, but you're up off the lows from 2008. So they realize that a tight labor market is something that they are very focused on here today. David.
Okay, Taylor Riggs from a sunny Fayetteville, Arkansas. Thanks so much, Taylor. Now we turn to Domino's Pizza. Domino's is the second largest pizza restaurant chain in the world. And it has, we're going to put up a chart here, nearly 15,000 locations in over 85 markets. It delivers more than 1 million pizzas every day. And it is responsible ultimately for more than 310,000 employees. 15,000 of those are directly employed by Domino's. The rest are through franchisees. The stock has shown very strong growth through the tenure of the current CEO, Patrick Doyle, as you can see right now on this chart. And we welcome Mr. Doyle now, coming to us from company headquarters out in Ann Arbor, Michigan, a town I know very well. Welcome. It's good to have you, Patrick.
Thank you, David. Appreciate it.
So this is Jobs Day, and you have insight into a lot of jobs around the country and around the world. One of the things that we are really puzzling about is how many jobs we're adding, how many people are coming into the workforce, and yet we're not seeing real wage pressure. What are you seeing, both at Domino's and through your franchises?
Well, it's an awfully good economy for us right now. And so, first you start from the top line. And, as we do the analysis on our business, The biggest predictor of growth for our business is employed people. So more, employed people buy more pizza than unemployed people, and so the continuing job growth is a very good thing for the growth of our overall business. On the wage side and the labor side, it certainly is a strong labor market right now. But you're seeing some increase in wages. You're kind of a little bit under 3%. I think you're seeing actually higher growth than that on lower income employees, which I think is terrific. That's actually a good thing overall in the economy. To me, the key number, even as you see, unemployment down at 3.8%, is the workforce participation rate, still under 63%. I think that number can get up to 64, 65%. That's 2 to 4 million people that can still come into the workforce over the course of the next couple of years. So I think we're in an awfully good place right now. We're seeing people coming into the workforce. We're seeing the unemployment rate, continuing to inch down a bit. But I think it's the workforce participation rate is really what's preventing, a dramatic increase in wages at this point.
Which, interestingly, actually ticked down 0.1% in these numbers. Yep. Even as the unemployment rate went down, that went down evidently because more people were coming into the workforce. How many people are out there still who aren't looking for jobs but still could?
Yeah, I think the answer is, each percentage point of workforce participation rate is about 2 million people. And I think the U.S. has had a participation rate as high as 67% over the course of the last 10, 15 years. And so, you've still got a lot of people who could come back into the workforce that can help to fuel growth in the economies. But overall, I think it's an awfully good situation right now.
Going back to wages for a moment, Patrick, are you feeling any margin pressure at Domino's, or are you seeing your franchisees feel any margin pressure? Do you have to pay those drivers more money?
Yeah, we certainly are, and some of that is minimum wage increases, but as much as anything now, it's just needing to pay more to hire great people, getting more efficient with our businesses, which, from a delivery driver standpoint, which is the majority of the workforce in our stores, the more runs they can take per hour, the more tips they're earning. But we're certainly seeing some of it, but they're managing it well. The profits of our stores were up a bit last year versus the previous year. The cash-on-cash returns for our franchisees are terrific.
Demonstration of Wirecast.
Overall, it's a very healthy situation.
That's one part of the macro story, Patrick. The other is trade issues. And you have stores in India, UK, Ireland, as well as 718 over in Mexico. How did the recent tariffs and the prospect of ramping up of trade tariffs affect your business decisions?
It really does not. Because, for each of those markets, we're dealing with those markets. We're sourcing a lot of our food locally in each of those markets. So, the tariffs and things going on with trade really don't have much of an effect on us.
What about the tax cuts? Are you seeing any effect? Particularly in people buying pizzas, for example. Are you seeing effects of the tax cuts yet?
Yeah, I think it has certainly been a good thing for the economy overall. I think that's going to help growth. We're certainly ramping up investment. We've done some things with benefits. We've increased our 401k match. We're doing better on kind of partner benefits and taking time off for when people have kids. So, overall, I think it's been a good thing.
Quickly, gas prices are on the rise. Mortgage rates are on the rise. How does that expose your customers and change how they're going to eat?
Yeah, I don't know that mortgage rates are going to have any near-term effect because most people, if rates are going up, they're just simply not going to refinance like they might have been before. Gas prices a little bit more. That certainly can eat into disposable income a bit. The levels we're at right now, I don't think you see a lot of that. We certainly, when things got up to $4, back a few years ago, we might have seen some of it. What I would watch for from fuel prices, though, really is whether or not that starts to flow through into food costs. And that's something that we saw in the past. We're not seeing that at this point. We're still pretty good with our forecast for food, but that's the sort of thing I'd be looking for.
Patrick, really great to get your perspective on Jobs Day. Thank you very much. Patrick Doyle, Domino's president and CEO. All right, coming up, the hits just keep on coming for Deutsche Bank. More on what I'm watching next. That stock down almost 4%. This is Bloomberg. watching, aside from markets, aside from oil, and aside from the jobs number, is Deutsche Bank. The new CEO, Christian Sewing, taking hit after hit. The S&P downgrading its rating on the bank this morning. The stock is down about 4% over the last 2 days. But interestingly, up today. You're looking at it in rally now up over 3% because you had S&P Global Ratings say they have enough liquidity. That part of the conversation is going to wind up being okay.
Yeah, enough liquidity, but can they make money? And in order to make money, they'll be able to take risk, and are the regulators going to let them take risk? Because you have the FDIC and the Fed both saying, at least for the U.S. sub, we're not sure you have your arms around your business. And that, as a practical matter, can really constrain a bank.
Yeah, and if you can't manage your business, then how do you wind up actually getting revenue? That's the next conversation. But nonetheless, that liquidity fear getting priced out of the market a little bit for the equities. All right, well, recapping those May jobs numbers, blowout here, 223,000 jobs added in May. Unemployment rate drops to 3.8%, and year-over-year average hourly earnings rise to 2.7%. Fun factoid, African-American unemployment, record low, and it spread to whites also at a record. The very interesting tidbit in the jobs number.
It's a great and important fact.
Yeah, and the markets like it, rallying here, the dollar shooting higher as well as yields. That does it for Bloomberg Daybreak Americas. Coming up on Bloomberg Markets, The Open, Michael Gapin, Barclays chief U.S. economist.
From New York City for our viewers worldwide, I'm Jonathan Ferro. 30 minutes until the start of trading. This is the countdown to the open. Coming up, a happy president and blowout jobs report reinforcing expectations for a Fed rate hike this month. The G7 meeting hijacked by trade issues after the United States slaps metal tariffs on allies, and populist parties in Italy agreeing to form a government averting elections and fueling a bond rally in Europe. In the markets then, 30 minutes away from the opening bell with the stage set as follows. Futures very much solid off the back of that solid jobs report. Up 17 on the S&P 500. In the FX market, a stronger dollar with euro dollar back to 116.60, and treasuries very much on offer with yields up 5 basis points to 291 on a US 10-year. We begin with that payrolls report. The economy adding 223,000 jobs in May, beating economist estimates. The unemployment rate falling to 3.8%. Average hourly earnings, they rose to 2.7%. Bill Gross to Janice Henderson weighing in on the report.
Wirecast.
I think the most important number to me was the average hourly earnings at 0.3 and now annualized at 2.7%. And so, you know, are we making America great again? I guess from the standpoint of jobs and GDP, inflation moving higher in terms of wages. And so, you know, it's pretty much of a scenario where the Fed hawks basically think that they can move forward once, twice. Some say 3 times. I say June is the last.
Administration of Wirecast.
Joining us now is Bloomberg's Katia Dimitrieva, joining us from Washington. Katia, great to have you with us. Everywhere I look, this jobs report looks solid. What do you see?
Well, you're right. There were a lot of surprises this morning, too, with that jobs report. That 3.8% unemployment rate ticking down from 3.9%. And that was something that you'll remember in the prior month. We also had at a 3.9, which is a complete shock in that month as well. We were thinking maybe 3.9% holding steady, and surprise, 3.8. So that was lower. The main thing really is that there were fewer people who were marginally attached as well. So that U6 rate kind of ticking down, and that's something that people sometimes look to, especially progressive economists. You look at the headline number, you say, well, what about people who are marginally attached, people who stopped looking? That's also down to a 2001 low. Wage growth, surprise to the upside. Bill Gross was talking about the Fed there. No, the Fed will definitely be watching this one. 0.3% on the month and on the year as well, that 2.7. We've been asking questions about the wages for a long time. When are we going to finally see it tick up? This might finally be it. Every company we talk to is saying we're increasing bonuses, we're increasing wages just to hire more people. So we might actually finally be seeing that effect here in May's report. Participation rate, you know, the only thing that really marred it was that participation rate. Prime age workers 25 to 54 also down 81.8 from 82. That was a bit of a bummer. And men also trended down, but women still on top.
Katia, great work. Thank you. And much more from Katia throughout the morning to give you a roundup of that payrolls report. Joining me around the table here in New York, really pleased to say Rick Reeder joins us, BlackRock Global Fixed Income CIO, Bob Doll as well, Nuveen Asset Management Chief Equity Strategist, and Michael Collins, PGIM Fixed Income Senior Portfolio Manager. So we have a new leading indicator, maybe, Bob Doll, the President's tweets about an hour before. When the President looks forward to the jobs report, is it good? And if he doesn't tweet, is it bad?
I guess that's right. It's a new indicator. We can put in all our little models.
What did you make of that?
Just what happened. He saw the numbers, he liked them, and he wanted to tell everybody. He couldn't help himself.
It's a strange one because the President does have that privileged access to the economic data before it's released. We don't know for sure whether he saw them before he tweeted.
Oh, he did.
Bob Doll seems to think he did. The market responding slightly. Looking forward to seeing the employment numbers at 8:30 this morning. Whether he saw the numbers ahead of time or not, I imagine he's happy with the payrolls report he got, Mike Collins.
Yeah, absolutely. I mean, like we just talked about, the numbers were strong across the board, right? There's really nothing to poke holes in at this point. The one number that came out yesterday, though, that's a little disconcerting to us is the savings rate, right? Continues to go down. So even though wages are up to 2.5% or just above 2.5%, it's still not strong, right? Inflation is bouncing around too. So real wage growth really is pretty muted. So people are dipping into their savings to continue to spend, and that's worrisome.
The backdrop to all of this, though, Rick, is a pretty solid economy, which makes you wonder why this week we spent so much time worrying about, one, Italy, and two, thinking about taking out rate hikes for this year at the Federal Reserve in the United States.
So that says a couple of things. The economy, when you produce this many jobs at this point in the cycle, it is extraordinary. It is extraordinary. By the way, one other point, I mean, we're talking about 3.8 unemployment. It's actually 3.755. It's actually rounded, it's barely rounded up. The other side, I would say, when you look across industries, and I always like to see what is the breadth of the number to get a sense that you have one aberrational number in terms of one industry. You can't find an industry that was. I mean, manufacturing maybe get back a little bit, but it's pretty solid across the board. So the numbers are strong. And like you said, the one thing I would say is the numbers are strong now. I do think as you get into next year, it's going to be a difference. So when you think about, is the Fed going to go 3 to 4 times this year in total? They're going to go 3 to 4 times, probably 4 times. How much they go next year, I think, is a question. You're pulling forward a lot of growth with this tax stimulus, and you've got a lot of good things working for you. The global economy is decelerating somewhat. The forward anticipation of what the Fed is going to do is one that's a bit trickier, and that's the one that I think is nebulous.
So there's two important things you mentioned. The latter point on the Federal Reserve and the spread between, I guess, where the market is right now for next year, the year after, and where the Fed is. But the earlier point is something I wanted to cross over to Michael Gapin on of Barclays, the chief U.S. economist. He joins us from the trading floor in New York. Michael, great to have you with us. Rick pointing out that at this point in the cycle, it is pretty amazing that we've got prints of around 200K in the United States. And it does beg the question where on earth we are in this cycle. Michael, what are your thoughts on that?
I think historically you get job gains like this and the unemployment rate moves lower until it doesn't. So we're looking for the unemployment rate excuse me, to move to 3% over time. We think it's going to keep drifting lower. We think people may still be surprised at the amount of job growth that we generate. But as Rick mentioned, with all this fiscal stimulus coming in, we're going to need employment growth to get that output growth going. So 180 to 200,000 jobs a month, I think, is what we'll see over the rest of the year, and the unemployment rate will drift lower, and that's what will deliver the 3 to 4 hikes from the Fed this year.
How do you think the Federal Reserve will respond to all of this? How do you think the reaction function is shaped and primed at the moment, Michael? Because for many people, they might be nervous seeing 3%, a 3 handle on unemployment, and nervous to see us go towards 3.5. Do you think they will remain patient?
I think for now, yes, that this was a solid report across the board, and yes, the wage data ticked higher, but I think they need to see more evidence that they're behind in order to kick them off of their gradual normalization stance. So I think this report makes them comfortable with going in June. I think it keeps them in track for thinking they're going to keep going this year, but the data will confirm that over time. So I think they're fine where they are right now. The numbers may be a little hot. It's warm, but not so hot as to make them think, wow, we're behind and gradual is no longer operative.
Michael, just one final question for you, because I know you've got a busy morning on the trading floor. Just the final one. Moving through neutral, Governor Brainerd raised that yesterday in a way that I think many people might not have expected it to come from, say, a relative dove like Governor Brainerd. What are your thoughts on the Federal Reserve being able to move through the neutral rate?
Well, I think they'll have to, right? If we're forecasting the unemployment rate to drop towards 3%, it's a substantial undershoot of their estimate of NAIRU. So you'd think policy would have to get somewhat restrictive over time. We can debate on how restrictive it needs to be. So I think she's just looking forward and saying, we have a pretty good outlook right now. The unemployment rate is likely to drift a little bit lower. Maybe neutral isn't where we ought to end up, and slightly restrictive is where we're headed. The dot chart says that. So I think she's just talking in words what the dot chart already says. So I don't think it's entirely new information, but the fact that somebody like Lael Brainerd is now saying it, to your point, I do think means, hey, this is the direction that we're going.
Michael Gapin of Barclays, great to have you with us. Rick, reading your thoughts on that, the potential that we do move through neutral anytime soon and get a little bit more restrictive.
So I think the key to think about is this economy is extraordinarily different than the ones we've seen historically, meaning if you look at the numbers yesterday, core PCE is running at 1.8%. We're running at 3.75% unemployment rate, significant growth. You're going to get nominal GDP over 5 this year, potentially over 5, and core PCE is 1.8%, meaning you're not going to force the Fed's hand of any significant nature that, my gosh, we got to get ahead of accelerating inflation. You've got a technology difference that we have today versus historically. The shift in the nature of the economy, pricing, your ability to get pricing power is different. I don't think the Fed's going to be that pressured. Could they go a bit through the neutral rate? Maybe. But boy, I think there's a really different. You know, go historically and say what happens, and you think about what happens with productivity. You're not going to create that sort of inflation in this cycle. So do I think the Fed's going to move? I think they're going to move, then they're going to stop, and I don't think they're going to get that panicked. But what does it mean for this year? Pretty clear what they're going to do this year.
Michael Collins, let's bring up the dot plot, shall we, and have a look at the spread between where the Fed thinks rates are going to be this year, next year, the year after, and where the market is now. We've started to see that typical gap, that spread that we've got quite used to over the last couple of years. Next year, and much more so the following year. 2020, 100 basis point spread. Does that make sense to you?
Yeah, so the markets have done a full U-turn, right? I mean, last September, they were basically pricing in no hikes for several years. Yep. As of a couple of weeks ago, when the 10-year was up at 3.11, the markets were pricing in basically 6 hikes through the rest of this cycle, and the dot plot indicates 7. So the markets had fully priced in the dots, and now with this rally we've seen, the markets are pricing in now about 4 more hikes the rest of this cycle, which takes us to close to 275, which I believe is probably as high as they should take it, right? I think there's some evidence already mounting in the markets that maybe we're at neutral, right? Every cycle when the Fed hikes, the weakest links in the global economy start to crack. And it's typically in emerging markets, and it's typically the entities with the most debt. And you're already seeing, you know, Turkey and Argentina and maybe Italy showing signs of weakness here. And so maybe that's an indication that the Fed needs to really be careful.
And it comes at a time, Bob, when I keep hearing more and more, especially over the last week, buy America, buy US risk assets.
No question about it. In fact, one of the risks here is the dollar gets too much strength. This employment report validates growth is strong here. And we see bits and pieces every day that growth is weakening elsewhere, Europe, China, and that just pushes the dollar up, and that's part of the emerging market problem, among other things. So we've got to have this at a pace, not a gallop.
Bob Dole of Nuveen sticking with us alongside Michael Collins of PGIM and Rick Reeder of BlackRock. Coming up on the programme, we'll take it to Europe and catch up to what is happening in Italy. Populist parties in the country agreeing to form a government. That conversation is coming up next. And the market's about 19 minutes away from the opening bell, with futures absolutely solid here, up 0.6% on the S&P 500, up 3/4 on the Dow. Yields grinding much higher on Treasury. Switch up the board. 10-year Treasury shaping up as follows. In the Treasury market, yields higher by 6 basis points and back through 290 on a 10-year. From New York, what a week. This is Bloomberg. We're about 16 minutes away from the opening bell this Friday, with futures looking absolutely solid here in the United States of America. Ahead of the opening bell, futures looking decent, up by over 0.5%. Italy's Populist Party striking an agreement to form a government after weeks of negotiations. Giuseppe Conte, a law professor with no political experience, said to be sworn in as Prime Minister in just under an hour. Italian bonds climbing for a third day, sending yields back close to where they were just a week ago. Wall Street weighing in on the market moves on Bloomberg.
You need to be investing now, and I think you need to be investing despite the considerable volatility and uncertainty.
Funny, I think it's actually good for bond investors to kind of finally get some yield back. Will it bubble over? You know, it's very hard to say, but we should really respect the force of the market price move.
The question is whether this kind of market pressure sustain itself long enough to actually start hurting the economic cycle.
I don't think it's the mood in the market. I think it's the realization to the new change in the facts of you now have potentially here a referendum.
All this sort of very messy cocktail coming together in Europe could well send, particularly if it remains unresolved for a time, could well send, you know, euro back down to that 105 level.
Europe is looking incredibly cheap today, and that should be the biggest driver of investment sentiment moving forward.
Change in Italy happens all the time. What is slightly more worrying is the move to Eurosceptic politics, which has been happening in a number of countries, not just the UK, and that raises questions about how strong the European foundations are.
What we need to focus on is not the tail risk of Euro exit, but the fiscal spending plans.
This is a buying opportunity in our view.
Still with us, Rick Reader of BlackRock, Michael Collins of PGIM, and Bob Doll of Nuveen. Guys, let's talk about the obvious story for, I think, so many people in this market. The amount of people on that video there said it was a buying opportunity. How difficult was it to buy that market, or do anything in that market, Tuesday morning when liquidity just evaporated, Rick?
It was unbelievable. You know how there's points in your career you think about exactly the most extraordinary dynamics. Tuesday morning, I'll never forget, in my car, it's probably 5:15, 5:30 in the morning, and we're talking to our person in London who runs our international business, Scott Teal, and he said, he's chronicling, my God, Italian 10 years are down 6 points, they're down 7 points, around 8.5 points, 9 points. And so we made a decision to buy literally in our funds what was a basis point. It was not I mean, and next thing you know, it's 8, it's 7, and we started to work its whole way back. I mean, people don't realize in the markets today, liquidity is really tricky, particularly around stories. When you look at emerging markets, you look at Brazil, you look at Argentina, you look at Italy now. You know, people have to be really thoughtful in their portfolios about what is going to be the volatility. We're in a totally different zone than we were a year ago, 2 years ago, in quantitative easing, this incredible blanket of liquidity over the markets. Markets are going to be more volatile, and when you have news like you do, and particularly political change, markets are going to be really volatile and skittish around it. Nobody wants to be on the other side.
And you can see the chart, the bid-ask spread just blowing out. I mean, the liquidity, the conditions on Tuesday and through the rest of the week were really, really difficult. Goldman Sachs put out a nice report. I don't know if you guys got to read it, but the headline of that report was essentially whether liquidity was the new leverage and whether we really need to think about it in that way. Mike, are you giving thoughts to that kind of thing at the moment?
Yeah, I mean, I think people confuse liquidity risk with credit risk all the time. To Rick's point, right? Yeah. If you have a credit that has problems, there is no bid. I mean, people just step back. There was a high-yield company a couple of weeks ago, American Tire Distributors. The bonds are at par one day. The next day, they're trading at 56. There's no trading on the way down, right? You just lose 44 points overnight. So in this market, yeah, you have to be the provider of liquidity, right? You have to be able to step in and offer liquidity at the right time, like Rick tried to that morning. And it's tough sometimes, but you can really make money, I think, if you can step in and buy bonds.
Bob, do you think there's an appreciation for just what is going on and the lesson that we should be learning from Tuesday?
Not nearly enough. We're all talking about it. We're all discovering it as we go through. You see the same thing in equities. So many machines are programmed to buy and to sell at certain points. You can just see them take effect. And then when you lean against it the other way, like Rick tried to do, all of a sudden it's back to where it was. So liquidity, you can't get what you want at the price you see on the machine. Let's put it that way.
And you can't get out when you really want to get out, Rick. And that's probably the thing. Everyone always thinks there's going to be the exit, that they'll get out at the right time. And then the exit just does not exist.
You know, one of the, so part of what I think Michael was talking about is you have a dynamic that the way you make money, the only way you really create alpha in that environment is you got to be a buyer or you got to be a seller when the market's going the other way and try and pick away at it and try and find a place where the market's overdone because you're going to get this illiquidity. I think the dynamic we talked about before is not just that we're draining liquidity from the system. The Fed is draining liquidity from the system. the Treasury is draining a tremendous amount of liquidity from the system by issuing what is net $1 trillion of additional Treasury debt. People are going to realize that you're in a completely different paradigm because of this extraordinary draining of liquidity. Markets are going to be skittish, and it's a very different paradigm. And by the way, you used to have international buyers of U.S. debt that are changing in terms of how they're doing, and you got a very different paradigm than we had the last 2-3 years.
And it's trillions.
It's
with a T.
Yeah.
That's a big number. Somebody buys $1 trillion of something, they push the price up, and they sell $1 trillion, they push the price down. We can't forget that.
I want to head over to Rome just quickly and catch up with Bloomberg's Anne-Marie Hordern to get you up to speed on the political situation in Italy. Full 180. What's the latest, Anne-Marie?
The latest that we're waiting for Giuseppe Conte to be sworn in. Just about 45 minutes now, and it'll be taking place about 20 minutes behind me. What really the market and investors have been focusing on is the new appointment of the finance minister, Giovanni Trio. The thing with him is he's publicly called for a debate on Europe. He's not as Eurosceptic as Paolo Savona, but this article he wrote last year has been making the rounds, Jonathan. People who call for unconditionally leaving the euro as a cure for all ills aren't right. But neither is the European Central Bank President Mario Draghi when he says the euro is irreversible. And John, today the central bank is celebrating 20 years. It's their anniversary. Not really sure Mr. Trio is the birthday president Mr. Draghi wanted.
So this is Auguri Mario today. Anne-Marie Hordern, great to catch up with you over in Rome. That's the politics, Rick. They're playing out before us in Italy, fine. Do we now have the appropriate premium in BTPs to account for not redenomination risk, because you certainly don't get that with a 2 or a 3 handle on a 10-year, but for the idea that we're going to see this fight with Brussels to issue more BTPs, to issue more debt, to spend more money?
Listen, we have not heard the end of the Italian story. I mean, we were also comforted by the fact the finance minister, but you've got a fiscal dynamic that is really tricky today. You've got this euro confrontation is not going to end tomorrow. So the question is, today, do you have the right premium? And today, my sense is that you'll be okay here for a period of time. But as you get into the fall, there's going to be more tumult around this. And so you got to be really thoughtful about it. What is your exposure to Italy? And then, by the way, tangentially, what is your exposure to Portugal? What is your exposure to other parts of the periphery, even Spain, given the dynamics around Rajoy, et cetera? It's a different paradigm, and it's part of why you're seeing some of the international buyers that are now pulling away from the European markets. Really different.
So what's the optimal exposure to the periphery going into all of this over the next year, Mike?
You know, I think you take advantage of the sell-offs, right, to some extent, and I think the spreads generally are relatively wide. I mean, Spain is, you know, just inside 100. Portugal is 140 over. Italy now is just over 200 over. You know, I think the ECB will provide a backstop ultimately if things really melt down. I remember when I was a young sovereign analyst 25 years ago, Italy was having a political crisis and a fiscal crisis. What a surprise. And I had done all the work.
Nothing's changed.
I went into my boss and I said, I'm really worried about Italy, right? And he said, Mike, have you ever been to Italy? And I said, no. He said, it's a great country. It's been around for thousands of years. Don't worry about Italy.
Be around in
work on something else, right? So maybe that's the story going forward.
Bob Dole, just looking at Italian debt at the moment, fine. We've dealt with BTPs through the week. I'm still looking at Bunds. CPI is running at 2%, there and thereabouts, just below in Europe. And Bunds, the curve is still negative all the way out to 6 years. We still have an incredibly distorted bond market.
Yes, we do.
In Europe.
Yes, we do. And on top of that, an economy in Europe that's slowing, which makes it tough to get rates where they need to go.
Guys, you're sticking with me. Rick Reeder of BlackRock, Michael Collins of PGIM, and Bob Dole of Nuveen. Coming up on the programme, the analyst action that you need to know. That's coming up next in our morning calls. In the market, just over 7 minutes away from the cash open after a really decent jobs report, pretty much across the board. Futures still positive, up 0.6% on the S&P. Dow futures positive, about 0.75%. Treasuries on offer, yields are higher. Switch up the board. The Treasury market looking like this. 10-year yields through 290 just briefly. We're up by 5 basis points on the day. And some dollar strength against the euro and a whole lot more against the yen, with dollar yen approaching 110 all over again. From New York, this is Bloomberg. time now for some of the morning calls, a look at some of the big movers on the back of analyst recommendations. We begin first up with a call coming to you from UBS, boosting its price target on Apple to $210 a share. The analyst saying that the narrative is shifting from iPhone units to a consistent franchise with higher margins. Next up, MKM raising its price target on Twitter to a street high $43 a share. The analyst saying the company could eventually reach Facebook's levels of user engagement. And your third and final call coming to you from RBC Capital, downgrading Deutsche Bank to underperform with an €8 price target. Shares are down nearly 9% this week alone, despite today's turnaround. That's the Frankfurt price. We're up by about 3.4%. Much more on Deutsche Bank on this program in just a moment. The opening bell is coming up next right here on Bloomberg TV. After a really decent jobs report, futures looking solid. We are up by about 17 points on the S&P. From New York, this is Bloomberg. After the news flow we've had this week, would you believe me if I said we could be on course for a week of gains with these kind of moves in the pre-market? Futures firmer up by 0.8% on the Dow. On the S&P 500, we are firmer by 17 points. Futures up by 0.6%. 10 seconds away from the cash open. There's the opening bell for you. Switch up the board in the bond market after that really solid jobs report. Yields are higher, up 5 basis points to 2.90 on the 10-year. The dollar stronger against the euro and a whole lot more against the yen. Euro dollar down to $116.82. And crude just a little bit lower. We're down by over 1% to $66.31. Still with me around the table, all-star cast, Rick Reader of BlackRock, Michael Collins of PGIM, and Bob Dole of Nuveen. Rick, the story of the year for you, and let's begin with it, has been the front end of the yield curve and this push higher over the last 12 months on T-bills all the way through to the 2-year, and then over the last month, some stability. What's behind the stability?
So you're now pricing in the Fed. I mean, particularly if you think the Fed is going to slow, which I think they will, into next year. Listen, 2018 and maybe in 2019 in fixed income is going to be protect the downside. 2018 is going to be how do I generate positive return? If you split up the aggregate index, traditional index, the front end, the 1 to 3 year part, is actually up on the year. Back end's down about 4.5%, been more after today. It's a question of how do you protect it. Today, we like the front end carry extremely well. By the way, you can buy securitized assets off the front end of the curve, commercial mortgages, non-agency mortgages, parts of the credit markets. You put some spread on it, all of a sudden you're yielding 3.25, 3.5, 4 if you take some risk. Well, if I could take 4 without going out the curve, taking yield curve risk, or frankly quite a lot of credit risk, that in this environment is nirvana. And by the way, maybe I'll take some equity risk. Your portfolio construction has to be really different. Your fixed income today is, you think about what happened in emerging markets. Yeah. How do I keep and maybe make a little bit of money this year as opposed to having a negative? And I think that's the whole gig for 18.
Michael Collins, the gig for you?
Yeah, I mean, I like that front-end trade to some extent, right? I mean, one of our favorite trades are AAA collateralized loan obligations, which is a type of asset-backed security. It sounds esoteric, but they're actually really safe, really defensive, and they generate a spread of about 105-10 basis points over LIBOR, and LIBOR is close to 240. So to Rick's point, you have like a 3.5% coupon on something that's floating rate and AAA, and it's bringing in actually a lot of international buyers. But again, if you take a longer-term perspective, I think a lot of retail investors in particular that we talk to are hunkered down in the front end. And I think if you kind of look toward the next recession, and whether it's 2, 3, 4, or 5 years, you're going to be much better served by owning the 10-year at 3, which is ultimately going to go to 2 or lower in the next recession, which is going to generate the better returns over the long term.
So you say now is the time to add a little bit of duration risk?
Absolutely.
Would you agree with that, Rick?
No, I would. I mean, in terms of managing a duration today, listen, rates are going to stay low for a really long time. Europe can't move rates for now after this week, or even longer time. Japan's not moving rates for who knows how long period of time. Rates are going to go, but do I think the 10-year can go to 3.25, maybe 3.5? Absolutely. Would I start to wade into some duration? You know, as Michael said, at 3, maybe a bit back at 3. Yeah, I'd start to wade into it. You know, there are trades to do, including this morning, where you can start to be a buyer using the options market as you get closer to 310 to 325. That's a good entry point. Today, I'd let it go a little bit further before I'd start to add some duration.
And to put into perspective, at 310 a couple of weeks ago, we were pretty long there, to Rick's point, again, because there were 6 hikes priced in. That felt like the high end of the range. At 278, 280, we've cut a bunch here, right? So still being tactical within the range.
Bob, do you take some confidence away from the fact that the Treasury market, dare I use the word stabilised, because we've been all over the place this week, but if you're given where we finished every Friday on the 2-year over the last month or so, we've hovered around this 250 mark. We seem to have stabilised around the front end in terms of where we're topping out on a 2-year yield. Do you take some confidence away from that?
As an equity guy, I can live with that. The fear is that they just keep on rolling. Back to what you were talking about earlier. 4 times this year, 4 times next year. As an equity guy, I get a little scared. Yeah. I never believed it. I still don't believe it. I don't think the economy's going to warrant that. But on the other hand, back to the earlier part of the conversation, we're arguing for nominal GDP in the U.S. more than 5%. We haven't seen that in a long time. As an equity guy, I love that. It means more revenue growth. It means more earnings.
And equity's looking good this morning. 4 minutes into the session, up by 0.7% on the S&P 500. Let's get you some movers quickly and cross over to Abigail Doolittle. Abigail.
Take a look at the shares of Lululemon, John, soaring up more than 10% right now, hitting an all-time record high. This in a very strong first quarter where Lululemon beat earnings estimates by 20%, revenues by 5%. Comp sales grew by 19%, better than the estimate by a lot, which was at 12%. So strong right across the board. Those are the best comps, in fact, since 2012. Not surprisingly, the street's very positive. Lots of price targets raised. All of this as the company does search for a new CEO. However, Costco, not so much. Although off the pre-market lows, down about 0.75% at this point after they beat earnings and revenues. Revenues by more than 1%, a big number too, more than $32 billion. But gross margins lagged as they build out their online efforts. Investors not giving them a pass today with those shares lower. And then then finally, it's been a roller coaster ride this week for the banks. Right now, we're seeing a rally. Citigroup, Bank of America, JP Morgan, all higher, following the European banks higher, which are rallying on political uncertainties in Europe abating. Plus, take a look at the 10-year yield, John, up 5 basis points, up for a third day in a row, up more than 10 basis points over that time period, really giving the banks a lift.
Abigail, thank you. I want to bring in the conversation to Deutsche Bank. We're watching the stock. Shares rebounding from a record low despite the fresh blow of a credit ratings downgrade by Standard & Poor's. Joining us from Frankfurt, Nick Comfort, Bloomberg Financial Regulation reporter. Nick, talk to me about the justification, the rationale for the downgrade.
Well, it's S&P recognizing that they have their work cut out for them at Deutsche Bank, that they really, in terms of carrying themselves through this overhaul, so keeping staff motivated to bring in revenues while you're still cutting jobs and colleagues sort of the desk next over from you losing their jobs. It's tough to keep the morale up at the company as a whole, and beyond that, yes, they're talking about, well, I mean, even if this all pans out as planned, this is kind of a longer-term project that they've got going here. So by no means an easy fix for Deutsche Bank.
And this on top of the news, the reports, I should say, in the last 24 hours, Nick, that the FDIC had put the US subsidiary on a problem bank list. Just how much of a problem is that if they have been on that list, as reportedly suggested, for much of the last year?
Yeah, I was speaking to one fund manager today who was saying sort of, well, I mean, if you spend 5 minutes looking at Deutsche Bank, you know they are on a problem list already. So there wasn't much surprise in the fact that the FDIC had them on this list. The Fed also had voiced serious concerns about them before. But it just shows you how jumpy people are about Deutsche Bank shares at the moment. And any sign of weakness in this market, also with the turmoil we have in Europe at the moment, was really going to be pushing them down. So the reaction yesterday looked overdone, and you see the shares coming back today. But it's not a pretty picture.
It's not a pretty picture, and over the last year, we are down by 39%. In a letter to staff, the Deutsche Bank CEO said the following: the last few years were tough. Many of you are sick and tired of bad news. That's exactly how I feel. Yes, our share price is at a historic low, but we'll prove that we have earned a better valuation on the financial markets. Nick, just to finish up, we all know some really talented people at Deutsche Bank. I keep going back to this because I think it's really important. There are some really terrific, talented individuals that work at that financial institution. How much harder is it to keep hold of them now?
In terms of remuneration, I'd say, well, the mercenaries have probably left already. If you're still at Deutsche Bank, then you probably also care about the institution as well, or you have no choice to go elsewhere. But no, there are still some really good people there, and to keep them motivated will be tough. But if you can show them that they have a future, then maybe they can bring the best out.
Nick Comfort in Frankfurt, great to catch up with you. The stock rebounding in Frankfurt trading today by just over 3.5%. Bob Dodd, what was interesting this week is that the concerns over Deutsche Bank, the concerns over Italy, somehow spilled into concerns over US financials, with terrific earnings over the last year and a backdrop here in the United States that also looks rock solid. Your thoughts on that?
The financial system is global. It's not domestic. That's the issue. Having said that, the banks in the U.S. are in pretty good shape. Remember in 09, 010, they were forced to recapitalize, gun to their head. A lot of them hated it at the time. Today, privately, will tell you this was the best thing that happened to us. That's part of the European banking problem. They didn't recapitalize when they could. We like the banks. We're overweight. I have one problem with them. Everybody loves them. And so we're not maximum weight for that reason. I'd like to own more, but, you know, take Bank Friday a month or so ago.
Yeah.
The numbers were good, and the stocks went...
It's strange, right?
Over-believed, over-loved.
And the other question, Rick, and you and I have talked about this before, where is the optimal place you want to sit on the capital structure of a financial institution? Now, at the beginning of the year, I would have thought the answer was pretty clear. Right at the bottom, in the equity. Is that still the answer?
So the tricky thing about what happened this week, and think about now, what is the ECB's dynamic? So much of why people look at European banks, how do you grow net interest margin? The ECB is going to have a tougher time moving now. So part of what makes it, you know, I was looking at why are the ABNs or the INGs, why did they get hit? bit on this Deutsche news, you have a dynamic where it puts the banks in a trickier spot because of the ECB's ability to move, and then tangentially, if the dollar appreciates, then the Fed has a tougher time moving. It's a tricky dynamic. But I think it gets overstated. I think the market's focused too much on these near-term, the shape of the yield curve and what it means for bank earnings, given the regulatory dynamic, which is obviously easier, your earnings power, higher rates as opposed to the shape of the curve. I actually think, as Bob said, there's real value in them, but it's going to take a little bit of time for that to show through, I think.
Michael Collins, your view on the debt side of things?
Yeah, so we continue to really like the senior debt of the banks, right? I think it's extremely safe. The probability of default over 10 years is de minimis. The amount of capital they've built up is significant. The amount of liquidity they have is great. And we will go into the subordinated part of the capital structure if we're getting paid for it. What's happened in the last year, there's been such a rally in the subordinated debt and the preferreds that they've traded closer to the senior debt, and we've moved back up into the top of the capital structure. When you can get 140 basis points of spread in the senior debt, you don't really have to dip down. What's happening now is there's a little bit of wiggle room. The subs are starting to give up. I mean, Deutsche Bank subs have widened from 130 to 390 basis points of spread this year, right? I mean, that's an incredible move.
Just your thoughts on European CoCos. Great year last year for much of the year. A lot of that was some relief around Deutsche Bank, the mood music improving. Bit different this year. Do you like European CoCos?
You know, there's so much equity-like characteristics in those things, right? They can be converted to equity pretty quickly in a downturn. So we tend to avoid those.
Rick?
You know, you have to look at, so when you put pressure on some of those AT1s in the names that shouldn't be under pressure, there's some real value. Some of them were down. I mean, they were down 15 points or more.
I sensed you had fun earlier this week.
It was, I will say, fun. I can't tell you, I'm looking forward to tomorrow as well. It's
2 years older since.
We would, totally. But I think there's some value in it, but I think you got to be really careful. The point you made earlier about liquidity, there are natural buyers of some products, and those tend to hold in reasonably well because buyers tend to step in. Those don't have a lot of natural buyers. You got to be really thoughtful how you scale those positions, because when they go down, there's not the natural buyer base that comes in, which we learned again this week.
Guys, it's been a really thoughtful conversation. I've appreciated the insight from all three of you. Thank you very much for joining us. Michael Collins of PGIM, Rick Reader of BlackRock, Bob Dole of Nuveen. Thank you very much, gents. In the markets, we're about 12 minutes into the session. Really decent jobs report, really solid price action, up by 0.75% on the S&P 500, up by over 0.8% on the Dow. Sell-off in the Treasury market, reversing some of the big moves we saw earlier this week. We're up 5 basis points on a 10-year to 291. The dollar, more strength, a little bit against the euro, just a whole lot more against the yen, reflecting that improving risk appetite. A weaker Japanese yen, stronger euro, stronger dollar rather, dollar yen approaching 110 all over again. From New York, this is Bloomberg, and coming up, the G7 meeting hijacked by trade issues after the United States slaps metal tariffs on its allies. That conversation just around the corner.
This is Bloomberg Markets, The Open. I'm Kaylee Lyons here in the Hewlett-Packard Enterprise Green Room. Coming up on Real Yield, Bob Miller, BlackRock head of U.S. multi-sector fixed income.
The Trump administration firing the first shot in what could become a trade war with its allies, announcing tariffs on steel and aluminum imports from Canada, Mexico and the EU. Political leaders in Washington and around the world reacting to the escalating tensions.
Let me be clear. These tariffs are totally unacceptable.
Whatever they do in terms of trade actions that affect trade flows today will be encountered by a similar weight action from Mexico.
I think China, the European Union, Mexico, and Canada are finding that out today. And hopefully they'll realize that this president's going to do what he said he would do.
We think that there's a way for us to come to terms in a way that will be positive, but it will include us saying pretty clearly that there's some things that we can't compromise on.
The important thing here isn't the day-to-day bantering back and forth on this. What's important is, are people going to the table?
Joining us now from the G7 meeting in Whistler, Canada, is Michael McKee, Bloomberg's international economics and policy correspondent. Michael, talk to me about the reaction that we've had so far from U.S. allies, Canada, Mexico, the European Union as well.
Well, you know, John, that last quote there about are people going to the table, that's the real question. Nobody seems anxious to sit down with the Trump administration right now. They don't really believe that they would be an honest broker that you can trust. The reaction from world leaders has been quite amazing. We saw Justin Trudeau, for example, not only calling it inappropriate, totally unacceptable, but suggesting in a quote that maybe the American people might want to do something about this at some point. The EU's commissioner, the European Commissioner, Jean-Claude Juncker, called it a bad day for world trade. And he and Haruhiko Kuroda, the Bank of Japan governor, both calling it protectionism and suggesting that is completely unacceptable. The best response perhaps we got from anybody was the Mexican economy minister, Ildefonso Guajardo, who's been negotiating the NAFTA agreement. He said that the Trump administration shot itself in the foot. And that's kind of the reaction here. The man you don't want to be today is U.S. Treasury Secretary Steven Mnuchin. He's got to meet with all of the finance ministers and central bankers from the other G7 countries who are now all under these tariffs. And as Canadian Finance Minister Bill Morneau told us yesterday, he's going to hear about it. They're under instructions to let him know that there is much unhappiness among the G7 members. They've already announced a whole string of tariff responses, retaliation to the U.S. We can look at a little bit of what they're saying. The Mexicans are going to put tariffs on U.S. steel and agricultural products. The EU, of course, published that list of things that they would put tariffs on a while ago, including Harley-Davidson motorcycles. We saw the response from Paul Ryan. It's in his district. He said the president made a mistake. And the Canadians are going to put tariffs on U.S. steel and things like beer kegs and maple syrup. So it is going to be quite a day for the U.S. They're going to have to hear about it here in Whistler. We'll see what kind of defense Steven Mnuchin puts up. Treasury officials tell me he'll fall back on the idea that you got to have a strong steel industry to have a strong economy, and you need a strong economy for national defense. It's nothing personal, guys. It's all about keeping the U.S. strong. John?
Bloomberg's Michael McKee. Great to catch up with you, sir. I'm sure you'll be very busy throughout today, and you'll hear more from Mike on Bloomberg Radio and on Bloomberg TV. Joining us on the phone now from Washington, Isaac Boltanski, Compass Point research and trading policy analyst. Isaac, I don't know why people are surprised. The president's doing exactly what he said he would do. I think we maybe are surprised because the Treasury Secretary, Mr. Mnuchin, went around saying that it was a trade war on hold.
Yeah, I think you're absolutely right. Look, the recent trade policy volatility is endemic to the Trump administration, and it's going to be an omnipresent force throughout his tenure at 1600 Pennsylvania Avenue. So whether it's staff-level battles or the predictably unpredictable nature of his negotiation strategy, the president's simply being wholly consistent with what got him to this point in his career.
And Isaac, let's be really clear as well, sir. I think it's really important that this administration has identified some reasonable issues that need to be addressed. The barriers to entry in Europe, the significant barriers to entry in China that need to be removed. There's an argument about the approach. That's where there's a key difference about the approach of this administration to really address those key issues they've identified. What is the path to reconciliation? What is the ultimate approach that you think needs to take place to identify the approach and then tackle the issues?
Sure, there are important issues that are being talked about when folks are at the negotiation table, and I think that should be viewed as a positive. It's simply the unpredictability of the strategy that I think is spooking the markets, and rightfully so. You know, I think it's hard to live by the day-to-day tweets, and instead it's important to try to step back and look at the broader mosaic. And I actually think that we are going to see key policymakers step back from the precipice here for three main reasons. Number one is I think President Trump's ultimate goal is still more deals rather than fewer deals. Number two, I think that the economic and electoral impacts of a trade war will ultimately weigh on the White House. And number three, while the president's base, I think, is generally and conceptually supportive of the president's trade policies, the retaliatory actions that have been outlined thus far will ultimately hurt those folks. And I think that impact, that real world impact, will influence the president.
Isaac Boltanski, before we let you go, I do want to pivot from trade just very quickly to payrolls. You will be aware that the president tweeted that he was looking forward to the payrolls report an hour before the payrolls report actually came out. We do know that he has privileged access. We don't know whether he'd seen the numbers ahead of time. Isaac, what are your thoughts on that? Just connecting Washington, D.C. with Wall Street for a moment.
I will share with you something that a congressional staffer told me, which was this could just be one of those things, one of those abnormal things that becomes normal in the Trump era.
Some trading cues on Twitter ahead of the payrolls report. I hope not. Isaac Boltanski of Compass Point. Been great to catch up with you, sir. Thank you. In the markets, we are about 22 minutes into the session. Really decent jobs report. Solid price action on the screen, erasing the weekly loss. We're positive on the week now on the S&P 500, despite all the crazy news flow. What a week. This is Bloomberg. This is Bloomberg Markets, The Open. I'm Jonathan Ferro. It's time now for the Trading Diary. What you need to be watching through the rest of today and through the rest of next week. Walmart wrapping up its annual meeting later today. Taylor Riggs will run you through some of that on Bloomberg TV and radio throughout the afternoon. On Monday, Apple hosting its Worldwide Developers Conference. Tuesday, Tesla holding its shareholder meeting. That one could be interesting. Thursday is the Turkish Central Bank meeting, the scheduled one. Remember, they had an emergency one a little bit earlier last week. And President Donald Trump is meeting with Japan's Prime Minister Shinzo Abe at the White House. Joining me now, Bloomberg's Lisa Abramowitz. Lisa, what are you looking at?
Well, when people talk about the trade sort of dissonance that we're getting from the White House right now, I'm looking at commodity prices. I really want to know how much are steel prices increasing, how much are lumber prices increasing as we get more pushback from Canada. The answer is quite a bit, particularly steel. Take a look at the year-to-date chart of steel. Took a leg much higher after there was the confirmation that these tariffs on steel and aluminum imports would be imposed on the European region as well as Canada and Mexico. I think this is interesting. Also, if you take a look at lumber, it's steadily climbed as we've gotten increased tension with our northern neighbor, that is Canada. This means higher prices for houses, this to build them, right? This means higher construction costs. So at a time when we supposedly we're going to be talking about infrastructure, how does this play into all of those plans? I think that this is going to be an interesting indicator to watch.
And yet the issues in Italy, the issues with trade on the week, the S&P 500, positive. The equity market's looking quite resilient. I know we can talk about liquidity issues in the bond market in places like Italy, but for stocks in the United States, it's actually okay this week.
You know, you could paint this any way you want. You could paint this as the numbers that we've got out of earnings have been tremendous. Why aren't stocks up higher? You could paint this as why aren't they lower given all the trade tensions and headline risks? I think that that's the tension that kind of holding them steady.
Bloomberg's Lisa Abramowitz coming up on Bloomberg Radio without the tension, alongside Pim Fox coming up at the top of the hour. 26 minutes into the session, a check on markets for you. Positive after a really decent jobs report from New York. This was the countdown to the Open. This is Bloomberg TV.
10 a.m. in New York, 3 p.m. in London, and 10 p.m. in Hong Kong. From New York, I'm Bonnie Quinn.
And live from London, I'm Caroline Hyde. Welcome to Bloomberg Markets.
Posts a solid jobs report as global leaders react to tariffs. More on all of that in just moments, but first, let's get to some economic data. Bloomberg's Abigail Doolittle is with us.
Thanks, Bonnie. And we're taking a look at the May number for the ISM manufacturing report, and we're looking at a bit of a beat. The manufacturing ISM number for the month of May came in at 58.7 versus the 58.2 that the survey was calling for versus the prior month of April at 57.3. And remember, anything above 50 tells us that the economy is growing. So you put this number together with the very strong jobs report, and it's a consistent a consistent message of a strong economy. And we do have the markets trading higher on this solid economic data. The Dow, the S&P 500, and the NASDAQ all higher on the day. But it's been a very choppy week. And in fact, if we take a look at a two-day chart of the S&P 500, we are going to see yesterday the S&P 500 had been down about 0.7%. Now up about 0.8%, net up about 0.2%. So yesterday investors were worried about a possible trade war. Today we have this strong economic data. Earlier this week, uncertainties around Europe. So this year's theme of volatility continues. And on the week, we're looking at a mixed picture. Let's hop into the Bloomberg quickly and take a look at a chart that you can view using the GTV function. And these are the weekly gains or losses for the three major averages. So we see in January a very strong month and the big declines in volatility in February and in March. And this week, what we're looking at in white, the NASDAQ up 1%, the Dow down 0.5%. Right now, the S&P 500 up about 0.3%. A pretty decent divergence there. Really the first time that we've seen this year outside of a smaller divergence earlier in May. So it'll be interesting to see how this resolves next year, of course. And then finally, let's take a look at a few big movers on the day. On the open here, we're taking a look at Lululemon up 14%, a very strong first quarter. Comps came in up 19% versus the estimate of up 12.2% on geographic expansion and new products, hitting an all-time high. VMware also sharply higher in a very strong quarter, up 8%. But we have Ulta and Workday trading lower. Ulta actually beat, but the guidance a little bit disappointing. And for Workday, they beat, but there's some billing noise. But William Blair's Justin Furby is saying, buy that weakness, Caroline.
Buy that weakness, buy into the stock market in Europe at the moment, Abigail. We are seeing 90 minutes to the close of trading here in Europe, and we're having the best day in a month on the Stock 600. Check out the IMAP. We're currently up 1.2%. What's winning is the financials. We're currently up by 2.5%. The banks really outperforming. Let's check out which banks are on the move. It's the Spanish lenders. It's the Italian lenders. Why the money into stocks? Because we've got new leaders in Italy, new leaders in Spain, and therefore we see the likes of Unicredit raise higher, Intesa San Paolo raise higher, the likes of Banco Santander as well. So keep an eye on Italian lenders and Spanish lenders. Also, notably, keep an eye on the banks such as Deutsche Bank. Deutsche Bank actually trading higher today. That's even as we see Standard & Poor's cut its debt rating. Why? Well, because it's still investment grade. And actually, they're saying that the capital is looking relatively good. The liquidity is looking pretty good on Deutsche Bank. So we'll show those particular stocks in a little moment. But notably, we are seeing a good day for financials, up 2.5%. It seems as though relief floods the market as we have leadership in Italy. Sure, I mean, there's still concern that it's populist leadership. What does that mean for spending? We're going to see, of course, tax cuts. We're going to see spending rises. But nevertheless, it's better than the worst case scenario, which, of course, for Italy was potentially a new overall election. We're seeing, therefore, Unicredit up 5.3%, Santander up 4.2%, and check out Deutsche Bank up 4%, rising off that record low we hit yesterday. Let's move on a gear, though, because I also want to look at another particular industry group, and we've got to be keeping a close eye on another asset class as well. I'm looking at the euro, and I'm looking at Italian bonds. This is where we see the roller coaster week that we've had, and notably, the euro actually closes higher. Let's look at this blue line. Yes, sure, we had a rocky ride at the beginning of the week as Italy, of course, was concerns about the fact that we weren't going to see any sort of leadership there. We were going to see a new election coming to the helm. We saw, therefore, the euro really hit close to lows. But now we're trading up again. We have new leadership in Spain, new leadership in Italy, and indeed the yield spread difference between Italy and German bonds coming down, Vonnie.
Caroline, the Trump administration, of course, firing those shots and what's fast becoming a trade war with allies, announcing tariffs on steel and aluminum from Canada, Mexico and EU imports. And the response was quick and strong, as we've been seeing. Meantime, St. Louis Fed President Jim Bullard, speaking exclusively with Bloomberg, had this to say.
Everyone's talking about how the trade talks might change world trade arrangements. However, I think the proof's in the pudding. It really comes down to what is actually agreed upon as far as trade arrangements, and I'm not sure in the end that all that much is going to change.
We're joined now by Carlos Gutierrez, co-chair of the Albright Stonebridge Group. He's also former U.S. Secretary of Commerce and former CEO of Kellogg. A wonderful person to put some perspective on this. We obviously had Jim Bullard trying to dampen any hysteria down a little bit. But when you have the European Trade Commissioner, Cecilia Malmström, using language like retaliation will be measured, proportionate, she actually said this, Mr. Gutierrez, when they say American first, we say Europe united. It's military language. How do you even negotiate from a position like this?
Well, it's a very good point, because it's very hard to negotiate with a country in public when you have a gun to their head. And that gun to their head, of course, are all these tariffs. We have a lot of balls in the air. So I think that will be very difficult. And the question now is, will the president back down? And can he afford to do that? And what are the risks of backing down? Because our credibility is on the line, his credibility is on the line. If he continues and doesn't back down, then we have a real trade war. And that's going to impact not just the world, but it's going to impact the U.S. It may even impact us more than others, because our whole business model relies on inexpensive materials that are put into manufactured goods and then re-exported or sold here.
Carlos, it's wonderful to have you joining us, and I really want to get your sense of taking us back to when you were Commerce Secretary. You were bringing in landmark free trade deals, particularly with Latin America, for example. I mean, have we just moved so far away from that? You called at the time of the campaigns that the economic policies of Donald Trump were crazy. You called them a disaster. You stand by those comments?
Well, I think the trade policy is a disaster, yes. I like tax reform, I like regulatory reform, but regrettably, I think the trade policy has the potential of totally undermining any gains that were made through tax reform or regulatory reform. So this is extremely unfortunate, and we've opened up, three very large fronts. One is NAFTA, the other one is the European Union, and then, of course, there's China. So to carry out those three wars at the same time, I just think it's going to be devastating for the world trading system. It's going to be devastating for our own economy. It's going to cost us jobs. It's going to create inflation. Ironically, these steel tariffs are going to make it too expensive to build a factory in the U.S. And my understanding was that all of this was geared toward bringing manufacturing back to the U.S. Very unfortunate. We are trying to solve the wrong problem, which is the trade deficit. And that's why we're getting into this spiral, because somehow in the administration, there's a belief that the trade deficit is the big number to go after, and that's going to get us in trouble.
You know, Mr. Gutierrez, when you draw the ire of the Canadians, you know that there's something off in the global order. You know you're doing something wrong, right? Is the correct position for a Europe, for a Canada, to maybe not retaliate, to, be the quintessential free trade country and just not retaliate here?
Well, I think what you're seeing in terms of companies taking a position is that they are pursuing more free trade, but not with the U.S. So countries around the world are trying to open up new markets, negotiating new free trade agreements, because what they've learned from this experience is that, regrettably, you can't rely on the U.S. I was just in China a couple of weeks ago, and one very senior Chinese official said to me, look, the problems we're having with the U.S. are teaching us that we have to be more independent from the U.S., that we can't rely on the U.S. That has been the impact. Now, on the domestic front, these countries have to react because there are domestic considerations. And no one likes to see their government being bullied by trade, even if it is the U.S. So domestically, you almost have to respond. You can't allow yourself politically, from the standpoint of the stature and the image of your own country, you can't allow yourself to look weak. So that's what's happening here.
There is a great op-ed in the FT today called Make America 1929 Again, and the point is that that's what this is doing. There is absolutely no economic logic to this, but there is a political logic, and the forgotten Americans that perhaps President Trump was speaking to during the election will be seen. This is helping them be seen, but not to their economic benefit in the long run. You ran Kellogg for a long time. What do you do as a CEO in this position? Okay, you're still hoping for things to get turned around, but it doesn't look like they're going to get turned around anytime soon. So what do you do?
Well, I think the first thing is don't panic, even though there's a lot going on, because things are ever changing. If we would have had this interview 2 days ago, we'd be talking about something else. And if we have this interview in 3 days, we may be talking about something very different. So be careful about making big strategic decisions that you may not have to make. But definitely have a plan B, because this can spiral out of control very, very quickly. But if you start moving supply chains now, you may find that a month or 6 months or a year from now that it wasn't necessary. But you've got to be looking at this very closely. You have to have a plan B, and you have to be ready to move very quickly.
Mr. Gutierrez, I'm looking at a fantastic Bloomberg function that really shows you world trade flows. In the U.S., the number one partner, trading partner of the United States is indeed China. Where do you see the relationship going for China and the United States going forward, and indeed CEOs that are trying to potentially look to that as an area of supply going forward?
Well, this is not good for the relationship, and it hurts because the Chinese, of course, are wondering if they, as I mentioned before, if they can rely on the U.S., if it's smart to be so dependent on U.S. imports and U.S. inputs for manufactured products. And of course, the ZTE example highlighted this. So they're thinking through that. On the other hand, there will be repercussions on the ground that may not make headlines in the U.S., but will hurt U.S. companies doing business in China. For example, permits that take longer than they should, or licenses that are withheld, or joint ventures that are not approved, or acquisitions that are not approved. Things of that nature that just make life miserable for companies, that is a form of retaliation. So this is taking the U.S. and China relationship back. It's not good for anything else we're trying to do, whether that be North Korea or whether that be trade. But if we're looking for a better relationship with China, this is definitely taking us in the wrong direction. Same thing is happening with NAFTA. You know, the favorability of the U.S. in NAFTA has gone back down to where it was in the 1980s when Mexico was very protectionist. That went back up during NAFTA to all-time highs. It's right back down again. So this is not good for relationships with anyone in the world. The European Union, as you know, are very disappointed. What's happening is that the world is retaliating, and they will continue to retaliate, and that's going to hurt us. If you take the example of steel, if steel is 20% of your cost, you have to raise prices at least 5% to keep margins even. And that's assuming that everything else stays the same. If your sales decline as a result of the 5% increase, then your margins start to change. This is not good for anyone.
Mr. Gutierrez, our thanks for your time. That is Carlos Gutierrez, co-chair of Albright Stonebridge Group, the 35th U.S. Commerce Secretary, and before that, chairman and CEO of Kellogg. Let's check in now on the Bloomberg First Word News. Here's Kaylee Lyons.
Vonnie, the U.S. unemployment rate has matched the lowest level in almost 5 decades. The economy added a more than expected 223,000 jobs in May, and the jobless rate fell to 3.8%. The jobs report reinforces expectations that Fed policymakers will raise interest rates when they meet later this month. In Spain, lawmakers have made it official. They've booted Prime Minister Mariano Rajoy from office after 7 years. Rajoy lost a no-confidence vote in Parliament. That set the stage for socialist leader Pedro Sanchez to become Prime Minister. He's backed by the anti-established group Podemos and some Catalan separatists. And populist parties in Italy will take power today with a program for fiscal expansion that challenges European Union rules. The new Prime Minister will be Giuseppe Conte, a law professor with no political experience. He was sworn in moments ago. Populist leaders have spooked markets with a program that includes tax cuts and a spending spree. There will also be guaranteed income for the poor. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Kaylee Lyons. This is Bloomberg. Caroline.
Wirecast. Kaylee, thank you very much indeed. Now, coming up, it's been a terrible week for Deutsche Bank shares, and now the lender's credit rating gets cut. But interestingly, the CEO, Christian Sewing, says there is no reason to be discouraged, and shares off by 9%, but they're actually rebounding today. We're in Frankfurt next. This is Bloomberg.
From New York City, I'm Vonnie Quinn.
And live from London, I'm Caroline Hyde. This is Bloomberg Markets. Now, Deutsche. It's another setback for Christian Sewing, and the CEO of Deutsche Bank. His efforts to reinvigorate Europe's largest investment bank are taking back-to-back hits. Now, of course, today, Standard & Poor's Global Ratings cut the lender's rating in the early hours of the morning. This following reports that its U.S. unit was put on a Federal Reserve list of problem banks. We're joined now by Nicholas Comfort, Bloomberg financial regulation reporter, live from Frankfurt. Give us a sense, Nicholas. I mean, we actually saw the stock recover somewhat today, but this can't be good news that it's even lower in investment-grade territory, tinkering on potentially sub.
Yeah, absolutely. So the bank is quick to point out that they've done a lot of their fundraising for the year in the first quarter already. But if your rating is cut, then you tend to be able to only raise money in the future at more expensive rates, and that does hurt your business. And so it's clearly a bit of a problem for them if they want to be doing more business, they want to be more aggressive, they want to get back in the market. To do so with this millstone is not easy.
What about the millstone of cartel charges coming from a deal that they did in Australia? That's going to be yet another setback for the CEO.
Yeah, for me, that's more of a headline problem rather than a really big financial one, because Deutsche Bank, the lion's share of their really big, sort of very costly settlements are out of the way. I mean, things like the U.S. mortgage probes and LIBOR and so on. So the really big ones, the ones which be dragging down profits significantly, are gone. But on the reputational side, it does not help if you're dragged through the headlines every day, and your staff suffer from that. Your clients, they also think many clients maybe don't want to be doing business with a bank involved in that kind of business.
I mean, Mr. Saving did try to perhaps calm employees today. He sent out a note, notably saying, we have got the clear strategic direction for the investment bank. Is anyone believing him?
That's a good point. So we do have some information on which businesses they'll be cutting back at the investment bank, but clear strategic direction is something I would have phrased it differently, I think, in that case. There's a lot of points which we want more clarity on, and investors want more clarity on too.
I'm sure you'll be finding that clarity. Bloomberg's Nick Comfort in Frankfurt. Wonderful to have you on, as always. More to come next. This is Bloomberg. This is Bloomberg Markets. I'm Caroline Hyde in London.
And from New York, I'm Vonnie Quinn. It's time now for our weekly ETF report. Let's get to Abigail Doolittle.
Thanks, Vonnie. And private equity is one of the last frontiers that has yet to be democratized by ETFs. However, there are some ETFs that come pretty close. Here to discuss is Eric Balchunas, Senior ETF Analyst at Bloomberg Intelligence. And Eric, this is just so interesting, the idea that you really are not able to play private equity through ETFs. But you have a very interesting idea, microcaps. Can you talk to us about that?
Yeah, and I won't take credit for this idea. I've read a couple blog posts in the past few months that are basically making the argument that PE is overrated and you can actually get it through small cap or micro caps is even better. These are companies in early stages of growth. They don't have as much analyst coverage. They have less financial strength. They kind of have a lot of attributes that a private equity investment would have. And so there's actually 4 ETFs that track micro caps. And they're really not that well known. And all the stocks that these things hold aren't in any of the broad market or small cap. They're kind of a hidden area. The 2 big ones, though, that I think people are going to have to choose between is IWC is the iShares. That's the biggest one. Market cap weights, basically the micro caps, right? You're kind of your standard play. It's like the IWM or the IWM of micro caps. FDM, on the other hand, is a smart beta play. You can see from the number of holdings there, it holds only 200 microcaps. It really looks for liquidity and fundamentals and picks them like an active manager. And that's outperformed. The smart beta play has done better. And people who are posting on this are saying that active and smart beta is a better way to do microcaps because there's a lot of more disparity and ways to find value. But we did look, the average active microcap manager, only 30% beat IWC. But FDM, again, is smart beta, and that is winning. So it's a decent choice for people.
Well, speaking of winning, small cap this year is really on a tear, up about 8%. How are these microcaps doing in comparison?
That's the thing. They're having a great year. They're all about 10%. That's leading all the cap sizes. So
even outperforming.
Yeah, and one of the reasons is they're protected from the dollar, right? And they're also benefiting from tax cuts. So we have a lot of research on this from our equity team. And so they're really having a nice surge now. That's indifferent to my bigger case on how they can be used in placement of PE. But now, yeah, there's also maybe a reason to look at them based on current trends this year.
So that's microcap. In 20 seconds or less, is there actually an ETF that does mimic private equity?
No, but there's an ETF that holds private equity companies like Blackstone and KKR. That is PSP. Some people like that, but again, that's holding companies that profit from their private equity fees, but isn't exactly private equity. So those are kind of the 2 options you have.
Great investment insights here and ideas. This is really pretty unusual. Thanks for sharing with us, Eric. That was Eric Balchunas, our ETF analyst here at Bloomberg. Bonnie, back to you.
All right, thanks, Abigail. We do have some breaking news now. The Petrobras CEO has resigned. That is Pedro Parente, of course, was in the news earlier this week. On Tuesday, he pledged to protect Petrobras' bottom line. Despite the changing political landscape, of course, there's been a nationwide trucker strike, and almost all of the presidential candidates oppose Petrobras' daily fuel adjustments. Jobs numbers next with Diane Swank.
Sir, please believe me, I am in this business for the last 12 years. Okay, I'll wait for your call. Thank you so much.
This is a demonstration of Wirecast.
They still don't know you after all these years? क्या करें? पहचान ही नहीं है.
Simple solution है. List on the stock exchange. With listing comes recognition. Investors get interested in you. And funding happens.
Come on, yaar. I'm not big enough to list. Chal, let's leave.
There's a stock exchange exclusively for your kind of company. NSE merged. it's the right platform for your business.
Really?
Yeah.
My kind of company?
Exactly. Get listed, get recognized. अरे भाई हीरे की असली परख जौहरी को ही तो होती है. चल.
NSE Emerge, साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
Catching up on news feels like a test match. Want the highlights? We hear you.
It's an ocean of news out there. Need a navigator? We hear you. Do you have analysis paralysis? A case of too much information and not enough time? Do you wish someone would just pick the most relevant topics and tell you what you need to know? We hear you.
Good morning. You're watching Bloomberg Quint. This is First Word.
Curated and presented by Bloomberg Quint's senior-most editors. Weekdays at 8 a.m.
Watching Prime Time, I'm Tamanna Inamdar. Let's take a look at the top stories this evening. It's a temporary reprieve for power firms facing insolvency. The Allahabad High Court orders that no action be taken against power companies on the basis of the central bank's new stressed asset framework. They also request the Finance Ministry to hear their plea. Farmers across India go on a 10-day nationwide protest. Demands include right prices for crops, farm loan waivers, and implementation of MS Swaminathan Committee report. The CBI summons former Finance Minister P. Chidambaram for questioning on June 6th in relation to the INX media case. It's a month of joy for automakers as sales surge. Maruti clocks the best monthly sales in over a decade. And GST collection figures for April exceed the average mop-up after the launch of e-way bills, but falls slightly short of the previous month's collections. Spain does not have a prime minister as Mariano Rajoy fails the floor test. Socialist leader Pedro Sanchez will become the next prime minister of Spain.
This is a demonstration of Wirecast.
Well, the Allahabad High Court has requested the Finance Ministry to consider a plea filed by the Independent Power Producers Association of India. The plea sought to not bring stressed power assets under the IBC framework unless they are willful defaulters. Bhanvi Arora sums up the development.
The Allahabad High Court has provided a temporary relief to the power companies against RBI's new stricter bad loan norms. The court has said that no decision will be taken against the power companies till the Finance Ministry hears the disagreement. The order was passed by a bench headed by Chief Justice of Allahabad High Court, Justice Dilip B. Bhosle and Justice Suneet Kumar. The Secretary at the Finance Ministry will decide the date and time of the meeting in June, which will include all the power producers, including the one who has filed the petition. RBI, in its Feb 12 circular, had laid down strict timelines for initiating insolvency proceedings. Now, according to the Association of Power Producers, almost 60,000 to 70,000 megawatt power projects will be pushed towards bankruptcy if these norms were to be implemented. Earlier in May, Power Ministry had to meet their RBI counterparts, but the meeting was deferred. Power Ministry had also asked the Finance Ministry to seek an exemption for the power sector for these norms, but the Finance Ministry had put down the request saying that they cannot provide a relief to the particular sector.
All right, Harry Dhaul, Director General of the Independent Power Producers Association, joins us on the phone line. Very good evening, Mr. Dhaul, and thank you for speaking with us here at Bloomberg Quint. One key question, how much of a relief, of course, but why the special treatment for the power sector? Because the RBI's stringent norms impact other key sectors as well.
Well, number one, the reason for the differentiation in the power sector has two parts to it. The first part is we are a regulated sector, and unlike other sectors, we are already being regulated left, right, and center by all kinds of state and central regulations, government policies, etc. And therefore, before you start mechanically putting us in the same category as anybody else, with due respects to the Reserve Bank, you need to understand where the problem lies. Imagine that you go ahead mechanically and refer these $75 billion worth of power projects to the NCLT because they become NPA. The question then comes, why have they become NPA? The NPA they have become is because the government companies, Coal India, etc., are not supplying coal to the required level of the kind of quantity and the quality. Second is the railways, which again is government control, is not able to supply the coal on time. If you look today, you'll find there's a coal shortage across the country in most power plants. Last point is the buyers of power, which is the distribution companies, are not paying money on time, etc. They are excuses that they are running into losses for whatever reason. Now, if the problem lies somewhere else, by mechanically passing an order saying that you must be subjected to what everybody else is being subjected to, is not going to solve the problem. You're going to pay $75 billion worth of bad assets for no rhyme or reason. So our submission is that you need to find a solution because there's no point shooting the wrong guy.
Okay.
The problem is not with the power producer. The problem lies somewhere else, which is in the government hands. And government has been subsidizing the distribution companies since 2002.
Sure.
And the second point which I want to make is, in the power sector itself, there's a distinction and there's a discrimination happening. NTPC and Power Grid and NHPC, which are government undertakings, for the last 10-15 years, are getting special treatment in getting their money from the state discoms through what is called a subvention scheme, whereby if the state discom doesn't pay NTPC, there is this threat that the state subvention will be taken away. There's a tripartite agreement with RBI and the state government to do this. If that is the case, then why should the private power producer be discriminated against?
Okay, Mr. Dhaul, you've put your case well, and of course that is perhaps what has got you the reprieve from the High Court. But just give us an idea of whether any of these projects actually went through the resolution route. Were there conversations with banks? Was there any progress there? And what was the problem at that end?
The problem is very simple in the power sector. If you imagine you are the owner of a power plant, you have got see, there are two cases. One is you have a power purchase agreement, or the second, you don't have a power purchase agreement. If you have a power purchase agreement, then you are supposed to get, let's say, 100 tons of coal. You're getting 50 tons of coal. And you're being told the balance 50 tons you have to buy through e-auction, which means that what you have contracted to be given to you as a power producer is being sold on the open market to unregulated people like cement, steel industry, etc. They don't have a regulation. They don't have a tariff cap. They don't have all these kind of difficult things that the power sector has to go through to make sure consumer gets cheap power. Second point is, if you don't have a PPA, as per the Electricity Act 2003, we were supposed to have market or competition in an open market. That has been absolutely stifled and crippled by various agencies, including the distribution companies. They do not allow you open access. They don't give consumer a choice. And the result is there's a shortage of power. There's an increase in power prices. In the last couple of weeks, you can notice power prices went up to 11, 12 rupees. Now, in theory, the power price is supposed to come down. If you create these artificial barriers and create these artificial situations, you are not going to get the best results. And therefore, the answer does not lie in mechanically saying, all right, anybody who has an NPA within 24 hours, he should be referred to wherever he has to be referred to.
Okay. What is the way forward now, Mr. Dhol, now that you have this reprieve from the High Court? What is the way forward to relieve the power sector and some of these projects from the list of stressed assets? Where do we go from here?
Basically, where we go from here is we are very positive and keen to work with all the stakeholders and the government agencies to make sure that the consumer gets continuous high-quality round-the-clock power, just as our Prime Minister has visualized, at a reasonable price. And to do that, we need to get rid of all of these artificially created aberrations which stop these guys from performing, stop the private producers from performing. That's number one. Number two, we are also very excited about the fact that even the Parliamentary Committee has commented on this. So has the Ministry of Power and the other agencies and the stakeholders. And I think this needs to be taken very seriously, where discrimination against the private power producer versus the government power producer is removed. We want to be treated on par. When I switch on my light, I don't know it's a private fellow's power or it's a public. It doesn't make any difference to me. Electricity is electricity, number one. Number two, electricity is a national asset. Number three, electricity is the lifeline of this country's economy, which is about to take off in a very big way, thanks to the vision of the present government, which is in the mood to solve problems and not create them.
Okay. Thank you so much, Hari Dhol, for speaking with us. That was a perspective from the Powers Producers Association. But let's also get you a quick reaction from V.G. Kannan, CEO of the Indian Bankers Association.
I do not foresee a possibility of Reserve Bank of India actually changing it only for one sector. If at all, it has to be done for all sectors. So that, unless it's a very one-off case, but I am not too sure about it. Other sectors could say that why only one sector, if at all RBI agrees, it should be action the others. Let us wait and watch and how it progresses.
This is a demonstration
Well,
of
it was a news story which wasn't to be. This morning, a prominent financial newspaper reported that Chanda Kochar has been asked to go on leave. ICICI Bank's board quickly denied that report. Vishwanath Nair gets you all the action through the day on the ICICI Bank MD and CEO.
Private sector lender ICICI Bank on Friday released a statement to the stock exchanges as well as to the press saying that it is denying any news report which suggests that the MD and CEO of the bank, Chanda Kochar, was asked to go on indefinite leave. Along with that, ICICI Bank has also denied that it has appointed a search committee to look for a successor to take over after Chanda Kochar. Now remember, this whole conversation and this controversy started with a news report in Mint that came out Friday morning, which suggested that the MD and CEO of ICICI Bank had been asked to go on indefinite leave by a majority of the independent directors on the bank's board. This was in conjunction with an investigation and an inquiry that has been initiated against Chanda Kochar in the Videocon Group loan case. Remember that back in 2016, there was a blog post which suggested that in the matter of approving loans for Videocon Group, Chanda Kochar had breached the code of conduct or had been subjected to some kind of conflict of interest because her husband had business dealings with Venugopal Dhoot, who is the promoter of Videocon Group. The bank at the time did not respond to any of this, and later on in 2018, when this topic became hot again, the bank clearly denied. In fact, the bank's board put out a statement saying that it fully supports its MD and CEO and does not believe that she acted in any way that was against the code of conduct. But that was in March 2018. After that, the bank said that it had received another anonymous complaint against the MD and CEO about some serious issues with the way she had dealt with certain corporate loan accounts, and thereby the board has now initiated this independent inquiry through an independent person who will be appointed by the audit committee of the board. All in all, at this point in time, the bank is claiming that Chanda Kochar is actually on a planned leave and has not been asked to go on indefinite leave by the board of the bank.
Well, India's manufacturing activity showed some signs of moderation in May. The Nikkei India Purchasing Managers Index fell to 51.2 in May from 51.6 in the previous month.